All right, we're going to break down the 5 absolute game-changing ideas from the one book that Warren Buffett says changed his entire life. Now, this isn't about some secret formula or how to get rich quick. Nope, this is about a timeless way of thinking about money, about risk, that builds real, lasting wealth.
And look, that's not just some casual recommendation. When the most successful investor in history says a book completely changed his life when he was just 19 years old, you gotta pay attention. This is the bedrock of everything he built.
So, what exactly did he learn? What are these core principles that have held up for decades and decades? Let's dive right into the very first one, which is probably the most famous idea in the entire book.
Okay, let's meet a character named Mr. Market. Benjamin Graham, the author of the book, he invented this guy to explain just how irrational the stock market can be. And honestly, it's a brilliant way to understand how you should act. So picture this. You own a fantastic little coffee shop. It makes good money, you've got loyal customers, you know the business inside and out. Now imagine, every single day, your neighbor, we'll call him Mr. Market, he barges in with a brand new offer to buy the whole place from you.
On Monday, he's just bursting with excitement, yelling, "Coffee is the future! I'll give you $1,000,000 for this place right now!" But then on Tuesday, he shuffles in, totally depressed. Coffee's dead," he moans. "50,000, take it or leave it." You wouldn't, right? Of course not. You'd probably laugh in his face. His wild mood swings have absolutely nothing to do with how much your coffee shop is actually worth. And yet, this is exactly what we do with the stock market every single day. We let Mr. Market's daily drama dictate our biggest financial decisions.
And that right there is the huge difference. Mr. Market is pure emotion. He just bounces back and forth between fear and greed. But the intelligent investor, you're analytical. You don't get sucked into his drama, you use it. When he's panicking and offering you a great business at a ridiculously low price, that's your signal to act.
So here's the big takeaway. You are in charge. The market is your servant. You use its prices when they're helpful, and you completely ignore them when they're not. You never, ever let it tell you what your business is worth. This idea of ignoring the noise leads us perfectly into rule number 2, which really gets to the core of what so many people get wrong. There is a massive, fundamental difference between investing and speculating. And you know what? Confusing the two is just a recipe for disaster. Let's think about it like this. Investing is like buying a house you actually plan to live in. You're going to check the foundation, look at the neighborhood, the schools. You do your homework because you're in it for the long run. Speculating, that's like trying to flip that same house based on a hot tip, just hoping you can sell it to somebody else for a quick buck without ever caring about its real condition. I mean, let's be real for a second. Would you ever buy a steak in a local pizza place without knowing if it even has customers, or what its rent is, or if the pizza's any good? No way. But people do this all the time with stocks, buying just because of hype. This right here is the critical mindset shift. You are not buying a little ticker symbol that wiggles around on a screen. You are buying a fractional piece of a real-life, breathing company with real employees and real products. And the rule is simple. If you wouldn't be willing to buy the entire business, you shouldn't even buy one share. All right, rule number 3. This might be the single most powerful tool for managing risk ever created. It's called the margin of safety, and it's all about building a buffer for when things inevitably go wrong. So imagine you're an engineer, and you have to build a bridge. You do the math, and you know the absolute heaviest truck that will ever cross it weighs 10,000 pounds. So what do? Do you build a bridge that can hold exactly 10,000 pounds? Absolutely not. You'd be fired. You build it to handle 30,000 pounds. You build in a massive buffer for error, for bad weather, for the unexpected. And that giant 20,000-pound gap, that is your margin of safety. In investing, it works the same way. You do the work to figure out what a business is really worth. Let's say it's $50 a share. You then refuse to buy it unless the price drops to something way lower, maybe $30. That discount, that gap, is what protects you from bad luck, bad timing, or just being plain wrong in your analysis. Now, Graham was a really smart guy. He knew that not everyone wants to spend their weekends becoming a financial detective, so he laid out 2 very different but equally valid paths to success. The key thing is you have to pick one and commit to it. Let's think of it like going to the gym. The defensive investor just wants to stay healthy. They show up, they do their routine, maybe jog on the treadmill. It's simple, it's consistent, and it works.
They just buy a broad index fund, like one that tracks the 500 biggest companies, and they let time do the work. The enterprising investor, on the other hand, they want to compete. They're training for a marathon. They're putting in serious time and effort, hunting for those hidden, undervalued companies. And here's the thing, both of those paths can lead to success. But the absolute most dangerous place to be is stuck in the middle, kind of picking stocks but not really doing the deep research. That's where most people get hurt. You gotta pick a lane.
And all of this leads us to the final and honestly the most important rule of all. Because after you've analyzed the business, after you've dealt with Mr. Market, the very last person you have to beat is yourself. Your biggest financial enemy is staring right back at you in the mirror.
These things right here, these are the real enemies of your wealth. It's almost never the market crash that actually ruins people. It's their reaction to it. It's the panic selling at the very bottom. It's the greed that makes you buy at the very top. It's that fear of missing out or FOMO that makes you chase some hot stock you heard about. Success isn't about having a genius IQ. It's about mastering your own emotions. Look, you can't control the market. You can't predict what it's going to do next week, let alone next year. It's completely pointless to even try. Your one and only job is to have a rational plan and to control your own behavior when everyone else around you is losing their minds.
So when you put all 5 of these together, you start to see that they're not just 5 separate tips. It's a whole system, a philosophy. You tame Mr. Market, you buy businesses, not lottery tickets, you always demand that margin of safety, you pick your path, and above all, you learn to conquer your own worst instincts. Every single part supports the others.
In the end, it really all boils down to one simple truth. Buffett himself said that the stock market is a device for transferring money from the impatient to the patient. And these 5 rules, well, they're the blueprint for becoming one of the patient ones. The only question left is, are you?